Hello and welcome to the webinar, Getting It Right from the Start, How Payment Providers Can Reduce Fraud in Early Onboarding. My name is Megan Billingsley and I'll be your moderator today. Before we get started, I have a few housekeeping items to share with you. At the bottom of your screen are multiple application widgets you can use. All the widgets are resizable and movable, so feel free to move them around to get the most out of your desktop space. Please note the slides will advance automatically throughout the presentation. To enlarge the slides, click the Enlarge Slides button located in the top right-hand corner of your presentation window. We encourage you to submit questions at any time throughout the presentation using the Q&A widget. We will try to answer these during the webcast, but if a fuller answer is needed, or if we run out of time, it will be answered later via email. Please know we do capture all questions. Finally, following the presentation, you will be able to access the on-demand recording of the webinar using the same link from today's live event. So let's get started. Please help me welcome our two experts today. They will discuss how payment providers can help reduce fraud before it even starts in a place commonly overlooked, onboarding. Robert Ellenhorn is a payment risk expert at EverC, where he focuses on risk mitigation and anti-money laundering and describes himself as a passionate financial crime fighter. Catherine Flanagan is Senior Director, Merchant Risk and Underwriting at QuickFee and has a depth of experience in credit risk management. Thank you both for being here today. Payment providers know that a fraudulent client is costly. It can damage the company's reputation and customer relations and cause regulatory and financial challenges. But despite the provider's best efforts, it can feel impossible to keep out all the bad characters. One area in which many payment providers feel most vulnerable is when it comes to line of business verification, LOBV. Here, providers often overlook a critical verification check, the business URL or web address. The number of URLs has surged recently, and with that growth in business also comes a growth in fraud. By identifying fraudulent domains, payment providers can protect businesses and customers and make safety a competitive advantage. So let's find out what all of this looks like. Robbie, can you start us off with an overview of how the typical payment provider takes on a new business?
Yeah, definitely, and thanks for having us. So when a new business or an existing business wants to tap into the world of online payments and access payment networks, they're going to need a payment provider who is going to help them do that. So initially, they'll need to reach out to that payment provider and begin the process of onboarding. Typically, as you mentioned, it's going to come down to collecting two main pieces of information or establishing two main things. ID verification, which is who is the business, and then line of business assessment or verification, which is what is the business doing and what are they selling. Using that information, the payment provider is going to be able to decide whether they want to approve the application or decline it. There's various factors that go into establishing those two things in many different processes and procedures. One thing that's important to note is oftentimes those things aren't done entirely in-house, and almost all payment providers are going to use various third-party integration and outside tools to help make sure that the details that they're collecting aren't associated with any red flags. And they'll use those outside sources to help them make a final decision. So a typical red flag or a trigger for further investigation might come from any kind of discrepancy between the information received at onboarding by the payment company from the merchant itself and any of the signals picked up on by some of those identity verification or line of business verification providers or tools. In other words, if someone says they are one person and actually there's indication that they might be another, or they say that they're selling one thing, but what's actually going on the website or their line of business appears to be different, that's definitely going to be something that will need to be looked at further.
I'd really like to ask you about sort of these domain URLs because the number of them has increased phenomenally and it's anticipated to continue growing from 47% from 2020 to 2026. What's happening here?
Essentially, we live in the e-commerce internet age. It's never been easier to reach new markets and expand your customer base. And a lot of that comes from being able to sell online. And we saw that the pandemic and Corona definitely pushed this trend forward greatly. But unfortunately, it means that both legitimate actors turned to e-commerce, but so did illegitimate ones. Unfortunately, it's very easy to create a fake business or a scam, and it opens up a lot of vulnerabilities for payments companies. And with the amount of fraud and scams we saw during the pandemic, we can only assume that this is the tip of the iceberg, and a lot of those methods learned by fraudsters will continue to be exploited going forward. So with this growth in scale of URLs to be onboarded to the world of online payments, payments providers need solutions to help them deal with this scale, because it's almost impossible at scale to take the true resources you need to validate and understand each one through a manual review.
That makes sense. Thank you. So when it comes to fraud, what kinds of things are you seeing?
So it's a fast-moving world, and there's always a lot of different things going on. But a few of the ones that we've seen proliferate quite extensively, and also seem to be constant, are firstly a lot of lookalike URLs. That might be Amazon.com with a zero, or a well-known brand like Nike, but instead of Nike.com, someone registers Nike.outlet. And they try and pass this off as a legitimate URL selling legitimate products. Which brings me to our second item here, which are fraudulent and counterfeit products. This has proliferated greatly, and you can find for most large brands someone trying to ride off of their brand name and sell counterfeit or fake products. Where there's a crime, there's a necessity to launder the proceeds for it. And this brings us to our next item, which is transaction laundering, which is where a merchant will basically launder the transactions for the sale of something illegal through a merchant that is approved for an innocuous or legal line of business. And we'll talk a bit more about that later, because it's definitely something we see happening more and more, and in more complex ways from the bad actors. Lastly, lots of phishing threats and the generation of fraudulent URLs, which are meant to direct traffic to them to steal consumer information, whether that be credit card or identity information. Those are some of the main threats we're seeing.
How does this type of fraud affect legitimate businesses?
I mean, it can definitely make a payment provider less likely to work with an entire vertical. And, I've worked for a company that we had huge construction losses, and because of one fraudulent merchant, and they can do so much damage so fast that, it made them not trust the whole vertical. It turns into, okay, construction is it's too risky. The credit risk is too high, but it's not effective to eliminate an entire industry. You have to get smarter. You have to, determine the process up front and how you can kick out fraudulent applicants before they do more damage. So, and, as a payment provider, you have to be stringent. If you're letting merchant fraud come through, reporting, high fraud losses, merchants are going to have a hard time trusting you.
That brings up something quite important. As there's a lot of new industries entering the online space and entering e-commerce and accepting payments online, it becomes very important, one, to establish a framework of trust. These aren't face-to-face transactions, and both consumers and payment providers want to know that they're engaging in a transaction that's safe and secure. And what was brought up about, not doing business with an entire industry because of the risks associated with it, it's something that I think all payment providers face. And in the world of risk management, it's what we would call de-risking, which basically means instead of mitigating the risk associated with a certain vertical or line of business, there's a decision taken that basically we just won't support it because of the risk associated. And more we see that in a competitive landscape, it can be quite costly to de-risk entire industries. And it's very prudent for payments companies to use tools that help them to evaluate the risk of specific merchants without having to paint the broad brush of de-risking an entire industry. And that might mean looking at some of the very specific levels of risk associated with a merchant, whether that be financial risk and the direct financial risk involved, the jurisdiction they're from, the reputational risk of a specific merchant, and if there's been any red flags in the past, or the legal or regulatory risk involved with a particular merchant in a particular place selling to particular customers. Those are all important aspects that will need to be evaluated in order to enable onboarding clients, but doing it safely and mitigating the risk associated.
I think that's fascinating. And Catherine, you've worked in this industry for some time. You've established an onboarding process to help mitigate the risks Robbie was just mentioning. What's your onboarding process like?
Well, aside from, average KYC everybody knows and loves, there's so many more data points that, like Robbie was saying, you almost need to tailor to a vertical. So, you're going to look at e-commerce websites selling differently than the mom and pop shop that is selling lasagna down the street. So there's different things that, your basic KYC is just fine. And then there are some where you are wanting to look at that website and make sure that it's not a bad actor. And how long has the website been around? How long has the email been around? Where is their IP address located? If they say they're in New Jersey, but their registration's in California, it's not a deal breaker, but it is a question that needs to be asked. So, I love the way Robbie explains it because you really need to evolve. It's not a one size fits all for every merchant or every vertical. And, when I do create those onboarding guidelines and looking at all these things and creating a risk score, those all come into play. So, yeah, Robbie hit it right on the head.
Definitely. So one of the things that anyone in the world of risk management or fraud will be familiar with is that no matter what kind of processes you have in the general framework you have to mitigate and manage risk, there will be bad actors who get through and sign up, as bad actors are always adapting their techniques and are frankly very, very smart and cunning. And what it comes down to then is that there's a big difference in terms of damage control if you can figure out that you're dealing with a malicious actor on day 1 or day 2 versus after 6 months or after a very, very suspicious and problematic transaction has gone through. And I always like to put it this way. When it comes to onboarding, it's what's much better than kicking someone out is never letting them in the door in the first place. And that's where I think some of the additional controls or tools to be used at onboarding get to the heart of the matter and can definitely save a lot of pain down the line. That being said, we live in a world where it's a very competitive market, and a lot of payment providers and fintechs, they're in a very dynamic and competitive landscape where you obviously can't sacrifice SLAs to onboard, and you want to give a good customer to the good customer experience to the vast majority of merchants who aren't malicious and not hold up their applications so you can check everything. So it really comes down to being able to streamline that process and to get as many of the good people in the door as you can while raising a flag on those bad actors as early as you can. Obviously, with scale, that presents a difficulty, and it really means that you're going to need some information available so you can take the information about the IP address or the website or the identity of the person behind it and what's actually being sold on the website, so you're able to assess those things in a streamlined, efficient, and sensible way that makes the best use of what, in my opinion, is the greatest asset of any fraud or risk department, which at the end of the day are the human eyes and the analysts and the fraud managers. But they have limited capacity, and you definitely want to give them as empowered a framework as possible when they do have to take that extra deep dive.
So I'm curious then, Robbie, is there any point at which, in your experience, that companies should be evaluating their existing onboarding process, maybe something that they should evaluate where there are any weak points that need to be addressed?
Definitely. It's a great question, and the very short answer is always, and risk management is a dynamic thing, and implementing a risk-based approach requires constantly being aware of any kind of changes that are happening. That being said, a few of the big ones that usually might come up and should be kept in the front of mind are any dramatic changes to new product offerings or targeting of new segments of business or lines of business. That's more on the internal side. On an external side, it can always be a new regulation that comes up that will affect what kind of compliance and onboarding requirements any company will need to uphold. Then, unfortunately, there's also some worst case scenarios, which we hope no payment provider will ever have to get to, but they do happen, which is a bad experience where merchants or a particular segment of merchants have repeatedly defrauded customers or defrauded the payments provider, and now there needs to be a very urgent fix to how that part of onboarding is dealt with. It also could come from an inquiry from law enforcement, as risk and compliance departments know well that when the FBI or another law enforcement agency comes through and wants to assess and get info, it can bring some unwanted attention, and that's definitely something that can be a trigger for changes. Additionally, there's always paying attention to the broader trends that are happening and seeing where the world is moving in terms of fraud, in terms of bad actors, and that can, what we could be called headline risk, where you're seeing things in the news that maybe are happening to other payments companies that might necessitate a change across the industry.
So, Robbie, Catherine earlier had described some of the benefits and challenges of addressing fraud in a smaller business environment, but what kinds of challenges do businesses have as they grow?
Yeah, so I mentioned it before, but any payment provider is going to start out smaller and face the problem, but also a blessing of scale. When you're a small payments provider dealing with a relatively small pool of merchants, say 100 a week, it's possible to manually review them and really take the time to properly assess with human eyes each merchant. But perhaps a year later or 2 years later, when your company has exploded and expanded to various new products in geographies, and you have 50 or 100,000 merchants a month, Unfortunately, there's really no way you're going to be able to implement a thorough risk analysis through a manual process, and you're going to need to start bringing in some automated and scalable solutions. And on top of that, as your business grows, you don't want to kind of blindly walk in to entire new areas of business without understanding the risk associated with them or how exposed your portfolio is as a whole to a specific industry. And you're going to want to have some data to assess from a high level what risks you're exposed to. Just like one example to that might be that if you're a payment provider who decides to do work in the world of maybe a high-risk industry like Forex or marijuana or CBD, and you find that 70% of your portfolio is actually in that industry, you definitely want to be well-equipped to understand that and be aware that if there's a piece of legislation that's going to come and maybe change how consumers in a certain geography are able to legally buy that product, you want to be ready before that happens, but also understand that, okay, if that's 70% of your portfolio, on a certain level that represents a very tangible risk to your business. And if you're not prepared and you're not able to process for a certain geography for a time, there's a huge business cost to that. So that's where compliance and risk management really do help make sure that the business continues on unimpeded and is ready for any kind of changes that come about.
And on the flip side of that, Robbie, if they're not being compliant, there's huge issues that can happen. I mean, the fines are not cheap and they're not fun. So, and I've been part of companies where we've gotten these fines for face creams. So yeah, the compliance, especially, you say CBD, because every state is so different. And if you're not on top of it and, MasterCard comes and gives you a huge fine, it could be a big blow.
Excellent points. Thank you. Catherine had shared a list of details that she reviews when looking at a merchant. Robbie, is there a standard checklist you can use to verify merchants?
So as I mentioned before, risk management is always contextual and dynamic. And part of a risk-based approach is dedicating resources to the places where maybe you need to dedicate more in order to mitigate the risk associated with any particular merchant. So yes, there are, of course, best practices and checklists you can go through, but with a caveat that there is no one-size-fits-all to cover all of the potential risk. That being said, there's, of course, different ways to segment merchants and different things you might look for according to the profile of a merchant. And that might be where they're from, what they're selling. And a big part of what EverC does is help its clients to understand what their merchants are selling and to put, to, let's say, go through the appropriate checklist at as detailed a level as possible for the particular case they're dealing with in terms of evaluating a specific merchant and putting it within the correct context and framework to make a holistic risk assessment. Because as Catherine just mentioned, for something like CBD, there's obviously regional differences and different card scheme rules, and it depends who the end consumer is and where it's being sold. So we want to help our clients be able to make a decision on any merchant and go through that checklist as empowered as possible. So a very practical example of something like this could be that something as simple as nutraceuticals are viewed very differently for different payments providers, both in terms of their authorized use policies and their risk appetite, but also in terms of different jurisdictions. And the world of e-commerce is by and large international. There are localized payment providers, but most of the players in the world of payments want to enable their products to be used, of course, legally across the world. And so something, which might not even appear as something that would come up as something problematic based on where you live, like melatonin, for example, in the US, you can walk into any CVS or any Walgreens or any drugstore and go up and buy it over the counter. It's no problem. You can buy it straight off the shelf. But that same exact product with the same exact dosage in the UK actually is not an over-the-counter offering legally, and the merchant will need to be viewed very differently if they're selling to end consumers in the UK. So these are just some of the small points of things to be evaluated when going through that checklist about what's being sold and by who and to whom that are very important when making sure that compliance is being upheld.
Yeah, that's a good point about cross-border payments, because a merchant may just be unaware. Hey, you can't sell this in America. Hey, you can't sell this in Sweden. And it really does take either a risk professional or somebody from the outside to say, hey, you can't do this. Like, this will get you in trouble. And, I would love to think they're like, oh my gosh, thank you. But yeah, it's a really important part of cross-border payments, at least, in the e-commerce world.
Yeah, definitely. And I think it's important to distinguish between scenarios where you have a malicious actor who is selling something illegal intentionally, and that's basically the main offering. And then there's other merchants who may not even be aware that there's a compliance issue. And if you came to them and say, hey, actually, we just need you to know and we need you to configure that you don't offer a shipping option for melatonin to the UK because it's a prescription drug, they're happy to work with you to mitigate that. And that's a big part where it comes about when we talked about de-risking and, basically not dealing with a merchant or an entire segment of merchants because of the risk involved there versus just mitigating that risk. It's obviously preferable to be able to reach out to a merchant and say, hey, you have one or two problematic offerings here, and here's why. Let's work together to keep this relationship between the payment provider and the merchant, and just mitigate that risk and make sure we're compliant. And part of what we try and help our clients with is to enable them to go to their merchants with as much context and as much knowledge as possible to when it's possible, keep that relationship, but also when there is a malicious actor, when we see that it's not one product or two products, but they're selling illegal pharmaceuticals with no prescription involved, that they can deboard that entire merchant relationship. So in thinking about some of the very practical actions or processes that the payment providers and their risk departments and compliance departments can implement in order to tackle these issues, obviously there's no one size fits all, as I said many times, but it goes back to a few main points. You need automation. There can't be things flying through blindly where only maybe suspicious transactions are picking up down the line that there's some sort of problem here. Or maybe you stumble upon it through periodic review. But obviously, automation and technology that helps you understand what's on a merchant's URL, what are the products, who are they selling to, what's the entity behind it, what are the details listed on the actual website, and if there's any red flags associated with that. Technology and automation that helps with that definitely would go a long way in terms of healthy risk management process at onboarding. The next thing, and I personally believe in this a lot, and I think it's why it's really important that we're here and why it's so great that all of the attendees who have taken their time to be here are here. It's familiarizing yourself with trends, whether that be in terms of regulation or in terms of bad actor and fraud trends, and really getting that knowledge out to your analysts, to your first line of defense, and keeping them well informed. So when they come across something, they have the context and knowledge necessary to really know how best to act. And on that note, again, I think it's really important that we're all here, because if there's one thing I know, it's that the bad guys and the criminals and the people laundering the money, they are incredibly collaborative. And anyone who knows, if you ever go in the dark web or even in the clear web and search for how to exploit vulnerabilities of payment companies or to launder money, there's tons of guides and many people who are on the bad actor side very willing to help out and share their knowledge. And I think on our side as risk management professionals, it's very important to have forums like these to share sort of best practices and share knowledge so we can be up to the challenge.
Yeah, I love that, because I always tell my sales guys, you're my first line of defense. You get to talk to these people. They're giving you a vibe, and I need you to raise any red flags. You know, giving them knowledge too, maybe not the nitty gritty details because they just are, but, you know, giving them that, you know, basic, hey, here's what you should look out here for. Here's some red flags. Do they not want to take your call? Are they emailing you on a different email than this one? So yeah, I love to instill every time I work with a new set of salespeople, you're my first line of defense. And, you know, when this comes through, I want to know if you've had any red flags or weird interactions with the merchant before we, you know, start this review. And they've been great everywhere I go. They're like, okay, yeah, this is very serious. Okay. Because like you said, you know, showing them things like this, showing them fines, even like these things exist and people don't know, they don't realize they're in their own world of whether that's marketing or, you know, account management. And they don't know that these things are out there because me and Robbie exist. So we take care of it before it happens.
Yeah, I think there's always a push and pull between risk management and business enablement. And it's really important that those two things can exist harmoniously. And sometimes having a lot of the information collected at onboarding or with risk management tools actually can serve as sales enablement and give a better understanding of opportunities that exist in the market to safely expand and to give you the confidence to continue to grow. It's definitely something that I think all payments companies, especially fintechs who are growing, are dealing with. And the more they invest in thorough compliance and risk management and empowering the entire organization within that mindset, the more it's going to pay off down the line.
Excellent points. Thank you both so much. And this has been such an intriguing perspective on how payment providers should rethink the onboarding process and the importance of doing it at scale. In addition to a big thank you to our speakers today, we do want to thank our audience for joining the conversation. And we have a few minutes to answer some of the questions that have come in. But the first said that you had mentioned several types of fraud. Which one is the most prevalent among those you've seen for payment providers?
Yeah, so there's definitely no shortage of typologies of fraud. And especially in the pandemic, we saw all sorts of different kinds of frauds that really proliferated due to the circumstances we were in. But I'd like to focus on two particular kinds that I think we really saw expand. One I mentioned earlier, which was counterfeit products. And I think it's particularly relevant now in the economic situation we find ourselves in with inflation and a downturn in the economy. And whenever that happens, there's more of an appetite for people to buy cheaper products and search for a better deal. And with that comes great opportunities for all sorts of entrepreneurship and and legitimate merchants to capitalize, but unfortunately, with it comes also tons of merchants who want to sell counterfeit products and lure people with cheaper prices than the original. Or maybe not send any product at all and lure people with what they think is a great deal, but in the end they're just stealing their money and their credit card details and not sending them any product at all. And that brings me kind of to my second point. Something we've seen really explode is transaction laundering, particularly for the sale of counterfeit products. Transaction laundering basically is when one merchant selling something which they wouldn't be comfortable with payment providers knowing that they sell, like fake products or illicit narcotics or unlicensed pharmaceutical sales, selling those things on a website and then routing their transactions through a front merchant, which the payment provider is aware of, but they see it as something innocuous because it was presented as a website that sells shoes or clothing or something very innocent. So we see over and over again that some of these lackluster checks at onboarding where some red flags aren't picked up on means that they onboard some merchants that are supposedly selling shoes or clothing, but they're actually just serving as fronts. Now, there are ways to pick up on this, and some best practices in that regard might be the following. To kind of look at any red flags or discrepancies between the volume of transactions coming through, the velocity of them, their amounts, the profile of the cardholders who are buying them, and what's expected from the merchant and how they presented themselves when they were onboarded. If there's like a small shoe store in California, but you see that it's processing just crazy volume of transactions and the average transaction amount is $3,000, those are some very expensive shoes if the shoes that you see on the website that's supposedly selling them are priced at $60. It also might be suspicious if the shoe store is meant to be located in California, but you have transactions coming in from all over Europe and Asia and the rest of the US. These are the kind of things where you might open up the website again and open up the merchant profile again and say, hey, does this all add up? Does it make sense? And if it doesn't, you might need to have a good look and consideration if this merchant might be being used as a front for transaction laundering. And that's something that we've definitely seen proliferate. And both EverC's clients and EverC ourselves, we see a good swath of the world of payments because we have clients who exist across different parts of the payments ecosystem. We see that it's definitely becoming more prevalent, and the card brands and the regulators are also becoming very aware of this as well.
Excellent points. Thank you. I think our next question is actually a great point to end on. How does EverC help payment providers scale risk management?
Yeah, it's so there's a variety of ways, but I'll speak more broadly. We help our clients who are processing payments in the world of e-commerce to understand who their merchants are. And in the world of e-commerce, that starts with what's on their website and what are they really selling and what kind of details are they presenting there. In the internet age, the commerce is happening on the website. And that means that you need to know if there's a certain product on page 5 of the catalog that is problematic. You need to know about it. And we help them do that. That's one element. In other aspects, we view ourselves as a technological means to help deal with the problem of scale and to help, enable the most precious resource of any risk or compliance department, which is their human capital, which is their analysts and their risk managers, to use their time efficiently. And when they do need to give that human eye or human review, to do it in an empowered context, to know who the merchant is, who else they're associated with. EverC helps its customers understand that if there's a problematic merchant, what other websites have they opened in the past? What other websites are they operating currently? That's another element. And lastly, it's that high-level view of portfolio risk, to understand how much of your portfolio is in a specific vertical and what are the risks associated in that vertical. And that comes through a lot of forums like this and other things we put out about regulation changes relating to specific lines of business or different bad actor trends that are popping up, and making sure that you always have a finger on the pulse of where your entire portfolio stands with the data to back it up so you can make informed business decisions going forward.
Excellent. With that, we will close. Thank you again, Catherine and Robbie. As a reminder, today's webinar will be available on demand, and you'll receive an email with a link for continued access. Have a great day, everyone.
Thank you.
Bye, everyone. Thank you so much.